Good morning, hunters! Welcome back to the Daily Hunt for Multibaggers on this brisk Monday, March 9th, 2026. We're fresh off analyzing all the social media buzz and market insights from yesterday, March 8th, to bring you the most talked about stocks.
That's right, Ethan. Our AI scoured through a fair bit of discussion over the weekend. We're looking at a pretty diverse set of tickers, with some significant community optimism, especially in the energy and defense sectors, but also a few areas that definitely warrant a cautious eye. Overall, I'd say the sentiment is a mixed bag, but with some clear bullish indicators for specific industries.
Absolutely. A really interesting start to the week for sure.
So where should we kick things off today, Ethan?
Well, let's jump right into something that's always a hot topic, CL. Now, what's really fascinating here is the sheer volume of discussion around crude oil futures, with a strong bullish sentiment on rising gas prices, potentially heading towards that $6 a gallon mark nationally. Users are definitely signaling that economic impact could be significant, pushing investments towards, say, electric vehicles.
And that's where we hit a bit of a data puzzle, Ethan. While the user chatter is all about crude oil futures, the specific KPIs our AI pulled for the CL ticker are actually for Colgate-Palmolive, the consumer goods giant. And looking at those numbers, the picture isn't quite as bright. Their price to earnings at 35.57 and price to book at a whopping 13.96 are exceptionally high for a mature consumer staples company.
Yeah, it's definitely a disconnect, but it does highlight the broader economic backdrop. For Colgate-Palmolive, the news did point to some positives, like strength in emerging markets and a focus on AI productivity, which I see as a strong forward-thinking move. Plus, insiders have been buying up shares, with over 280,000 net shares purchased, showing confidence from within. That's usually a good sign of future growth.
Those are indeed positive operational indicators, Ethan, but we also can't ignore the elephant in the room. Colgate-Palmolive's debt-to-equity ratio, which stands at an alarming 2343.56. That's an extremely high level of leverage, which carries substantial financial risk. And while low volatility and a dividend yield offer some stability, a low return on equity at 4.97% suggests that despite all that debt, they're not generating proportional returns for shareholders. So even with the positive news and insider buying, it's a very stretched valuation, and the rising crude oil prices discussed by users could translate into higher input and transportation costs for a company like Colgate, putting pressure on those margins.
Good point, Brooke. Our AI hasn't rated Colgate-Palmolive on a podcast before, but considering the current high valuation metrics and the potential indirect pressures, I can see why caution is warranted.
Precisely. For Colgate-Palmolive, based on these specific KPIs, my speculative analysis would be to stay away. The valuation and debt levels are just too elevated to justify an entry right now, especially with potential macro headwinds.
Understood. All right, shifting gears, let's talk about KBR. This one saw a lot of weekend chatter with 36 hot leads, and users are strongly bullish, talking about a potential 50% upside and a major spinoff in 6 months. The sentiment is that it's deeply undervalued, trading at a PE around 11.46, compared to a sector average often over 40x. That low price to earnings is a huge draw, implying it's cheap relative to its earnings power.
I agree there's a compelling narrative, Ethan. Our KPIs confirm KBR's current price is very close to its 52-week low, reinforcing the undervalued argument. The PE of 11.46 is indeed attractive. However, we do see a negative revenue growth of minus 0.106. The discussion mentions this is due to contract scope reductions, not necessarily profit impact, but it's a KPI to monitor. Also, the debt to equity is still quite high at 191.73, which is a significant level of leverage.
That's fair, Brooke, but the user analysis also points to incredible resilience. They call KBR an unkillable government cockroach that has survived major controversies and still retains critical Pentagon contracts. On top of that, Q4 adjusted EPS beat consensus. They secured a new 10-year supply contract, and there's a massive backlog of $23.2 billion. Not to mention, insiders have been buying aggressively, with over 200,000 net shares purchased, showing strong internal conviction. This suggests those revenue misses might truly be temporary.
The insider buying is a strong signal, I'll give you that, Ethan. And the projected spinoff of their MTS division in late 2026 could definitely unlock value by reducing that conglomerate discount and potentially re-rating the stock. If their projected 13 to 24% annual EPS growth materializes, then the current PE looks even more appealing. This stock has never been mentioned on our podcast before, so this is a fresh look.
Considering all the forward-looking catalysts, the strong insider confidence, and that compelling PE, my speculative analysis for KBR is a buy. The potential for a re-rating and future growth seems significant.
All right, let's move on to LNG, Cheniere Energy, which also garnered a lot of attention with 15 hot leads. Our discussion around KBR also touched on the strong tailwinds for LNG. Oh, absolutely. The user sentiment here is very bullish, especially given the geopolitical landscape. Discussions indicate that U.S. LNG export infrastructure is becoming a national security priority, accelerating projects. News headlines like "New gas crisis looms over Europe" and "Oil crosses $110" highlight just how critical natural gas and energy supply are right now. Cheniere is perfectly positioned to benefit from this, with news about their Corpus Christi exports expanding. That broader market context is undeniably strong for LNG, Ethan, and when we look at Cheniere's KPIs, they are exceptionally robust. Their operating margin is an incredible 75.78%, and net profit margin is 27.35%. Even better, their return on equity is 58.73%, showing outstanding efficiency in generating profits from shareholder investments. The PE of 14.25 is also quite reasonable given these profitability metrics.
Exactly. They're making money hand over fist, and it's backed by very strong insider buying, over 103,000 net shares purchased, which is a huge vote of confidence. Plus, it's trading near its 52-week high, indicating strong positive momentum. The financials are indeed impressive. I do note the debt-to-equity ratio is still high, at 202.22, which is a considerable reliance on debt. However, their exceptional profitability metrics suggest they are managing that debt effectively, and the current geopolitical demand for LNG should continue to bolster their financial performance. And this isn't the first time we've seen this strength from Cheniere. It's been a consistent buy on our podcast, most recently in early March and back in November of last year. All signs point to continued strength. My speculative analysis for LNG, Cheniere Energy, is a solid buy. So, to wrap up our analysis for today, Ethan, it looks like we have a clear path for 2 of our 3 candidates. We sure do. Let's get that final list out to our listeners. Investigate as buy. KBR, Cheniere Energy, LNG. Investigate as cautious buy. None. Investigate as speculative gamble. Colgate, CL. And that brings us to the end of today's Daily Hunt for Multibaggers. This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice.
Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Thanks for tuning in, everyone. We'll be back tomorrow with more insights. Happy hunting.